So, good afternoon to everyone. We're just going to allow a few moments for other attendees to join us, so please bear with us. And we'll aim to get the update underway in the next 2 minutes or so. So please just be patient. So we're coming to you live this afternoon, and we're just going to allow as many people to join as possible before we get started. So we're very grateful for your patience. There's quite a bit to cover, and we don't want anyone to miss anything. But we'll just wait a few more moments and then we'll dive in. All right. So we're just coming up to 2 minutes past the hour. So I think we've allowed enough time for people to join. I realize it's a busy period, so we don't want to detain you for too long. But again, good afternoon to everyone and welcome to the 9th edition of the Eurosif Sustainable Finance Update. We'd like to thank everyone for taking time out of their busy schedules to attend these sessions. As always, we have quite a few notable developments in the realm of sustainable finance to cover today. And so with that, allow me just to bring up our agenda, and we'll take a quick look at what we're going to discuss, what we're going to provide you with an update with this afternoon. So first and foremost, we have the EU taxonomy and the approval in principle of the Taxonomy Complementary Delegated Act, or DA, that qualifies natural gas and nuclear energy as transitional activities in the EU taxonomy. That will be followed by an update on the ESMA consultation on the guidelines, or rather updates to the guidelines on the MiFID II suitability assessment. And in particular, elements of the suitability assessment that take account of client sustainability preferences. Then we'll provide you with an update on the work of EFRAG in developing sustainability reporting standards and setting up their various internal working groups. And finally, we will provide you with a brief overview of the work of the European Banking Authority in developing disclosure standards on the integration of ESG risks in the banking sector. So with that, I think, or no, rather one final bit of admin. As always throughout the update, we would welcome any questions that you might have. There should also be time at the end for a Q&A session. We've run over a little bit on previous updates. On this occasion, we're hoping to keep it a bit shorter so that people can ask questions and we can get back and respond to as many of you during the session as possible. And of course, if we leave your answer or your question unanswered, you can always contact us directly and we're happy to get back to you. And as always, the slides that we're using today will be available on our website after today's session, along with a recording. And of course, it's always accessible again on our YouTube channel. So with that all said and out of the way, I think we can dive into some of the substance. So as many of you will have seen, yesterday the European Commission approved the Complementary Delegated Act, including natural gas and nuclear energy in the EU taxonomy in principle. The first very important thing to note is that the complementary DA has not been formally adopted yet, and that's very, very important to underline. It is merely approved in principle by the College of Commissioners. And many of you may be wondering as to the significance of that, but we will of course explain. It is an important procedural aspect. The formal adoption will have to wait until translations of the DA are available in all official languages of the EU. Unfortunately, it can be difficult to determine when exactly the final text of the DA will be available in all EU languages. At this point, we would estimate, or reasonably estimate, that the process of translating the DA might take between 4 to 6 weeks from this point on. Now, of course, you will recall that the member states and the Platform on Sustainable Finance were given until the 21st of January to provide feedback to the draft Complementary Delegated Act. On the 21st of January, the Platform on Sustainable Finance published their feedback to the Commission on the technical screening criteria that the complementary DA envisaged for taxonomy compliant natural gas and nuclear energy activities. Now, the platform was quite direct when it came to pointing out that the technical screening criteria that would be applied to gas and nuclear activities were not consistent with the objective of climate change mitigation and the thresholds that had been established in the Climate Delegated Act for achieving a substantial contribution to climate change mitigation. To quote the platform feedback directly, they state, and I quote, "The technical screening criteria differ in fundamental ways to the technical screening criteria in the already in force Climate Delegated Act and are not consistent with the provisions of the taxonomy regulation." So the platform also further highlights that the technical screening criteria that would be applied to gas and nuclear do not ensure that no significant harm will occur to environmental objectives. So I don't think I need to go into the details as to why, because it's relatively apparent or self-evident. So in response, well, at least partly in response to the platform feedback and also feedback from the member states, the European Commission made a number of adjustments to the technical screening criteria, meaning that the provisions of the final text of the complementary DA differ slightly from the draft DA. And of course, during our last update, we went into detail as to what those criteria were. On this occasion, I'll avoid going into too much detail. What I will say is that in some instances, the Commission has, perhaps in response to criticism of the technical screening criteria being too lax, they've enhanced them. But then again, in other instances, they've further weakened some of the technical screening criteria that will apply to gas and nuclear. So for example, with regard to nuclear energy, the DA now requires member states to produce a more detailed and well-documented plan as to how they will dispose of high-level radioactive waste by 2050 through final disposal facilities that are yet to be established. With respect to natural gas, a more robust comparative assessment is required. That is to demonstrate that the natural gas facility is the most technologically feasible and cost-effective means of replacing power generation by solid or liquid fossil fuels. Perhaps another notable requirement is that this comparative assessment should be subject to a public consultation and thus subject to public scrutiny. That said, the Commission has also removed the interim targets for the phase-in of renewable or low-carbon gaseous fuels, meaning there is now only a requirement to switch fully to renewable or low-carbon fuels by the 31st of December 2035. So that kind of demonstrates, in a sense, that sample of some of the technical screening criteria, how some criteria have been enhanced, others have been weakened. Perhaps most important from an investor's point of view, the final DA has improved the disclosure requirements applicable to or related to taxonomy compliant gas and energy activities at entity level. So now exposure to taxonomy aligned and taxonomy eligible gas and nuclear activities must be clearly reflected in both the denominator and the numerator of the KPIs for non-financial and financial undertakings. Significantly also, the exemption for banks to report their debt exposures to gas and nuclear activities when reporting against the taxonomy has been removed. So that will bring greater transparency, which Eurosif certainly welcomes. In terms of Eurosif's reaction, some of you may have seen that we issued a statement in response to the Complementary Delegated Act this morning. We tried to strike a constructive tone. And in our statement, of course, we do point out that when you consider the purpose of the taxonomy at its inception, which was to provide a list of sustainable activities for private investors, gas and nuclear do not really belong there. We do, of course, take note of the platform's feedback and the fact that the technical screening criteria for gas and nuclear are not consistent with the objective of climate change mitigation. We also point out that in many instances, it will only be possible to verify compliance of gas and nuclear projects with the technical screening criteria many years after they've already been set in motion. And that we see as a serious limitation of the technical screening criteria. That said, we try to maintain a little bit of perspective or a sense of proportion. We think effectively, therefore, that the collateral damage of this complementary DA, while it does perhaps undermine the credibility of the taxonomy framework, should in real and in practical terms be quite limited. So of course, we highlight that the complementary DA doesn't interfere or alter with the application of the Climate Delegated Acts, which can, of course, still be used by investors as a very robust tool. We effectively describe, in a sense, the Complementary Delegated Act as a superfluous element of the taxonomy. It's not a core element. We, also point out, of course, that investors are not stupid. We don't quite put it this way, but merely including gas and nuclear activities in the EU taxonomy will not fundamentally change the attitude of sustainable investors toward these energy sources. There will still be an aversion. And merely now because gas and nuclear are in the taxonomy does not mean that sustainable investors will all of a sudden change their perspective. So of course, if I am to simplify things, you could say that merely just because you describe something as green does not mean that people will accept that. I could tell you my hair is blue, but of course it clearly is not. So of course, finally, to end our statement or our reaction on a positive note, we acknowledge the improvements to the disclosure requirements and highlight the need to enhance now taxonomy-related product disclosures. So if we move on just to the next steps, I'll reiterate, of course, the fact that the complementary DA has only been approved in principle, and it has not yet been formally adopted. And so when something is approved in principle by the College of Commissioners, it means that effectively there's no longer a possibility to change the wording or the text of the DA. It is, in that sense, now agreed upon at the highest political level and will not be subject to further changes. But at a procedural or technical level, there's still a need for translations into all official languages before it can be formally adopted. So again, this is very a tentative estimate on our part, but we would expect reasonably that the delegated act will formally be adopted at some point in March. And that allows, between 4 to 6 weeks for this translation process to occur. Once adopted, of course, as you're all very aware, the scrutiny period during which the European Parliament and Council can object to the DA will be triggered. Under the terms of the taxonomy regulation, each scrutiny period for a delegated act is 4 months, which is extendable by 2 months at the request of either Parliament or the Council. And so, having done just a few very rough calculations, accordingly, the delegated act could enter into force in either June or August, assuming, of course, as mentioned, formal adoption takes place in March and it encounters no serious opposition. So, of course, with that said, I'd have to mention that we are anticipating quite a bit of opposition to arise in the European Parliament, and so there is sort of a going at least to be quite a concerted effort on the part of several stakeholders, namely NGOs, to mobilize opposition in the European Parliament. Now, of course, the threshold or the majority required in the European Parliament to block the delegated act is 353 MEPs. According to some estimations, that is achievable. When it comes to the Council, it's the possibility of there being a majority to block the complementary delegated act is very limited, as something known as a reinforced qualified majority will be required in the Council. And effectively what that means is that at least 20 member states representing 65% of the EU population must vote in favor of an objection to block the DA. So with all of that said, I think we can open the floor just to see whether there's been any questions. And of course, feel free if you think of any questions to either ask them now or toward the end. So let me just see our Q&A. So we just have received a technical question on when companies and banks have to disclose their alignment exposures and for which reference period. So of course, when it comes to non-financial companies or undertakings, it will be as of the 1st of January 2023 that they need to disclose their exposures to gas and nuclear. Then, of course, in order to, and the reference period for that will be 2022. So the disclosure made on 1st January 2023 will reflect the year of 2022 and exposures to gas and nuclear during that reference period. When it comes then to banks as financial institutions, their disclosures of exposures to gas and nuclear obviously depend to a great degree on those of non-financial companies. And so they're given an additional year. They're given until the 1st of January 2024 before they need to disclose their exposures to gas and nuclear. So, you know, I hope that clarifies things. And if not, please feel free to reach out. So, with that covered off and the Complementary Delegated Act may be out of the way, we can move on to our next update. So of course, on the 27th of January, ESMA opened a public consultation on draft updated guidelines on MiFID II sustainability, or sorry, rather suitability assessments that clarify how firms should integrate client sustainability preferences. So as many of you are aware, MiFID II will require that firms take into account their clients' sustainability preferences during the investment process as of August of this year, so August 2022. And of course, in many cases, this process begins with the suitability assessment for a lot of firms. So first, when it comes to this consultation, maybe let's get some of the practicalities out of the way. The ESMA consultation will remain open until the 27th of April, 2022. So it's quite a generous consultation period. And of course, ESMA aims to publish the final updated guidelines in Q3 2022. So as a reminder, you know, on a practical point, guidelines typically apply 2 months after their publication in all official EU languages. And so accordingly, these guidelines, once updated, may not be technically applicable by August of 2022, but we can get into some of the misalignments in timing when it comes to these MiFID II requirements toward the end of this update. So of course, in the draft updated guidelines, ESMA has attempted to explain how firms should account for their clients' sustainability preferences in practice. And, you know, first and foremost, as you're aware, the MiFID II requirements require firms to first ask clients about their sustainability preferences and consider them as an addition to other aspects of the client's profile. So, for example, ESMA clarifies that, you know, the sustainability preferences of a client are to be considered after their other investment objectives. But nevertheless, you know, they must be taken into account. And of course, the challenge arises for firms when it comes to explaining to the clients the terms in which they, as the client, can express their sustainability preferences. So of course, the terms in which a client can express their sustainability preferences are prescribed largely by sustainable finance regulation. They should make reference to sustainable finance regulation. And this, of course, presupposes or demands a certain degree of knowledge that many clients will not have, and even, you could say, many financial advisors will not have. So of course, you know, the sustainability features or characteristics that a product derives, you know, from applying sustainable finance regulation are the terms in which a client must express their sustainability preferences. So, for example, a sustainable investment product may be described as having a certain share of taxonomy-aligned investments, or a certain proportion of sustainable investments, as defined by Article 217 of the SFDR. And of course, it is the client that gets to determine the proportion, say, of taxonomy-aligned investments or the proportion of sustainable investments. So the challenge really for firms is going to be explaining these terms in a non-technical manner, effectively giving their clients the vocabulary in which to express sustainability preferences. And so, you know, that is going to be, you know, as mentioned, a serious challenge. ESMA, of course, highlights that the client cannot be limited in the sustainability preferences that they express. And so there can be a combination of sustainability preferences that can be reflected in product offerings. So, of course, a product may then theoretically have a certain share of taxonomy aligned investments, a certain share of sustainable investments, and it may take account of certain principal adverse impact indicators also. So, you know, as we've mentioned in previous updates, when it comes to sustainability preferences under MiFID II, you know, ESMA has opened this consultation and intends to update the guidelines by Q3 2022. When you zoom out and consider the broader context, there is a possibility, I will not say a strong possibility, but there is a possibility that the Commission may defer the application of MiFID II requirements around sustainability preferences until at least the 1st of January 2023. So that would, of course, bring the application of these requirements into alignment with disclosures under SFDR and also disclosures under the taxonomy. And so, of course, those disclosures under the taxonomy SFDR will be fundamental for distributors to actually be able to offer or satisfy clients' sustainability preferences. So there's been no indication yet from the Commission that this deferral is going to take place, but we do know that quite substantial, quite influential elements of the financial industry in Europe have mobilized and have contacted the Commission advocating for this. Eurosif, I think, would be broadly in favor of such a deferral, just because it would render it far easier for firms to apply these requirements under MiFID II. But of course, we can't really say with any certainty at this point whether the Commission will actually, you know, decide to defer. So of course, with that, I think we can open the floor and see whether there have been any questions. And just conscious of time, you know, I won't dwell too long. I'll pass you over to my colleagues Selina and Federica now in a moment to provide additional updates. But first, we'll just take a look in our Q&A tab and see. Yeah, I think we may have preempted some of these questions. So probably most interesting here is, you know, the question that if a product has exposures to gas and nuclear, can that be consistent with sustainability preferences? And I think at this juncture, one of the issues around including gas and nuclear in the taxonomy is, of course, that now a product that has a share of its investments that are taxonomy aligned could, of course, include exposure to gas and nuclear. And it wouldn't, technically speaking, be labeled as green. Gas and nuclear have been qualified as transitional activities in the taxonomy. But nevertheless, it would broadly qualify as taxonomy aligned. And so, unfortunately, the reality is that if a product does have exposure to taxonomy compliant gas and nuclear, it could be consistent with sustainability preferences if expressed in terms of a proportion of taxonomy alignment in a product. Now, of course, as we mentioned, we are advocating quite strongly as Eurosif for disclosures to make sure that a client is duly informed of any exposures to gas and nuclear, because we wouldn't really be comfortable with them as part of the sustainable investment product. But I hope that answers that question at least. And if not, always feel free to reach out to us, and we're happy to correspond on that. But with that, I will pass you over to my colleague Selina for an update on developments with EFRAG. So I will just change the slide for you, Selina. And
perfect. Thank you, Hugo. And also good afternoon from my side. As said, we would like to give you a quick update on the recent activities within EFRAG and its sustainability reporting pillar. Just quickly to recap, EFRAG has been mandated by the European Commission to draft European sustainability reporting standards under the CSRD and is asked to submit them to the Commission as a technical advice. So we won't go into the technical details of each of the news, but we would like to provide you with a little bit of context on these news with respect to the development of the standards, so that everyone can decide for themselves whether and how this is relevant for them. So first off, we have a variety of calls for nominations by EFRAG. EFRAG over the past weeks has made several public announcements and calls. So we thought to give you an overview of who is who, and more importantly, who does what with respect to the development of the standards. So important to recall is that all bodies that you can also see on the slide act as the EFRAG sustainability reporting pillar. And there's also a financial reporting pillar, but this is now only the sustainability reporting pillar. And the pillar is there to provide this technical advice to the European Commission. The pillar comprises 31 member organizations, of which 13 new members have only recently been added, so mid of January. And these new organizations include European stakeholder organizations, civil society organizations, so for example, the WWF, Finance Watch, but also the European Trade Union Confederation. Within the pillar as such, we have on the top level the EFRAG Sustainability Reporting Board. And this is to be established. There has been a call by the European Commission for nominations of a chair and also for nominations of members. So the first deadline for the chair has just recently passed. The second one is still ongoing, so we don't have yet further announcements on this. Importantly to note, the candidates for the board members can only be nominated by the member organizations themselves. So among these 31 member organizations of the pillar. How is the board relevant with respect to the development of the standards? Well, the board is top level, so it oversees the whole technical work related to the development of the standards, and it will be responsible for all the sustainability reporting positions of EFRAG. So it will be the one that actually issues the draft and then also final standards documents under its authority to the Commission. The board also will appoint a sustainability reporting technical expert group, so the TEC, which leads us to the next little orange box. The TEC, Sustainability Reporting TEC, will, on the technical side, develop the standards based on its own professional judgment, arguments, technical analysis, etc. And as the name already suggests, it's comprised by experts in personal capacity. And the TEC work is then again also supported by working groups and advisory panels, which will be appointed by the TEC itself, probably this summer. And also here, there has been calls for nominations. So again, one for the chair of the TEC, and then also calls for members of the TEC, which can be still submitted until end of February this year. All right, and as you can see, these two kind of like main bodies are still in the phase of being established or announced. And meanwhile, we have the Project Task Force on European Sustainability Reporting Standards, or PTF-ESRS, which is currently taking care of drafting the work already. So once the two bodies, the board and the TEC, have been established, the PTF, so the task force, will actually hand over its responsibilities to these new reporting bodies. And also here, important to note, and you might have heard that earlier, The task force itself is also working closely together with external expert working groups. They have the role of reviewing the drafts, inputting on the drafts developed by the task force. And also here, there has been a recent announcement of these 11 expert working groups that have been established. All right, so that was just a quick update on the internal structure, so to say, of the EFRAG, the different calls for nominations. And on the next slide, we just give you a brief update on the latest activity of the task force, so the PTF. Namely, they have published a batch of working papers only for information reasons, so for everyone to better understand their conceptual thinking and considerations behind the elaboration of the draft standards. As you can see, the working papers include 4 drafts on cross-cutting standards, an elaborated draft on the climate change reporting standard. So maybe you remember from previous updates, we have talked about the climate change prototypes. That is now a more elaborate version of it. And also 2 conceptual guidelines, one which focuses on double materiality. So in terms of next steps, these documents will now be internally reviewed by the task force and the external expert working groups, as you saw before, and will then eventually be submitted for public consultation. And with that, if there are no questions on that particular part, I'll hand over to my colleague Federica.
Thank you. Thank you very much, Selina, and good afternoon to everybody. So we are focusing now on the ESG risks disclosure requirements for large banking institutions, because on the 24th of January, the European Banking Authority, or EBA, published a final draft with implementing technical standards on Pillar 3 disclosures on ESG risks. So the objective here of these standards is to set mandatory and consistent disclosure requirements for banks to provide qualitative information and quantitative information on both the exposure to ESG risks and especially climate-related risks, both transition and physical risks, and actions taken to mitigate those risks, including infos on how they are supporting their customers and counterparties in the adaptation process to climate change, and also in the transition towards a more sustainable economy. And how is this information provided? Also through the disclosure of exposure to financing green activities, where green activities mainly means taxonomy-aligned activities. So just as a reminder for you, everybody, to understand what is Pillar 3. So in the banking regulatory framework aimed at ensuring the ability of banks to manage financial stress and risks, which is based on 3 pillars. Pillar 3 deals with disclosure requirements and transparency risks. So we are talking about disclosure of risks. And the EBA standards have been developed in line with the requirements laid down in the Capital Requirements Regulation. So we are specifically in the EU law now, and the standards apply to large listed banks, so those that are subject to the CRR. So in practice, the EBA has published the final draft, which you can find online, with accompanying table, templates, and instructions to disclose all the relevant information. So very briefly, what are the banks required to disclose? First of all, qualitative information on ESG risks, and there are 3 tables provided for each dimension: governance, business model and strategy, and risk management, according to the TCFD approach. Then banks are required to disclose quantitative information on climate change transition risks, and 4 templates are provided. An example of information required is exposure to sector or assets of companies in the fossil fuel sector, for example. Then banks are required to disclose quantitative information on climate change physical risks, and a template is provided also for this. So assets that are subject to impact from climate-related events. And then finally, quantitative information on mitigating actions. So exposures on climate change related risks associated with taxonomy-aligned activities, exposure towards companies both subject to the non-financial reporting directive. So companies that are required to disclose taxonomy alignment figures according to the European law, and also companies that are not subject to the non-financial reporting directive, so that are not required yet to disclose taxonomy alignment figures. So more specifically, the European banking authorities provides ratios of the bank's green assets as a share of its total assets, where green mean taxonomy aligned, and we have two ratios: the green asset ratio, which is about taxonomy aligned activities from companies that are required to disclose figures on taxonomy alignment under the NFRD. And we already know this green asset ratio, because this is the same one as the one that is mandated by Article 8 of the taxonomy regulation. And the second ratio is the so-called banking book taxonomy alignment ratio, which is about the taxonomy aligned activities from companies that are not already required to disclose figures on taxonomy alignment according to the NFRD. So one thing that is worth mentioning at this point, and then I will leave it to the Q&A session, is that large listed banks will need taxonomy alignment information on companies not subject to the NFRD and in the future the CSRD. So the standards say that they can collect those information directly from companies or use internal estimates and proxies, but they have to explain how they do it. So this was just a rough update, and then I will give the floor to my colleague Hugo again, because I would like to leave some minutes for the Q&A session. Thank you.
Thanks, Federica, and thanks very much to Selina as well for those updates. So actually, we now have a bit of time to respond to some of your questions. So I think we can be proud of ourselves today. We haven't run over. And I noticed that in the Q&A, there's a few interesting comments, some very pertinent questions, which I may not have a very clear answer to, unfortunately, because it's recently in my mind been cast into doubt. Going back now to MiFID II sustainability preferences, one of you has asked whether the client can or should specify that they want, say, an investment product that has a certain degree of alignment with the taxonomy, or a certain percentage of taxonomy aligned investments as part of a product portfolio. Say 20% is the kind of example given. I think some of the messages that have come from supervisors recently would suggest that no, the client isn't necessarily to be encouraged to provide a percentage of taxonomy aligned investments or a percentage of sustainable investments that they want as part of a product. And I think the reason supervisors are saying that at this point is it has become apparent that, in particular, when it comes to taxonomy alignment, as things currently stand in the market, probably the most ambitious products can only achieve maybe 5% of taxonomy alignment when it comes to their portfolio. So for that reason, I think supervisors have gotten a little bit more pragmatic and said, okay, look, perhaps do not try to solicit a percentage from the client, because you'll be put in a position of having to tell the client that you cannot acquiesce, let's say, to their sustainability preferences, or you cannot cater to them or satisfy them. Having said all of that, if you look at the initial wording of the regulation, when it says that a proportion of the proportion of taxonomy alignment or the proportion of sustainable investments is to be specified by the client, I think what the draftsman had in mind was, of course, that the client would specify a percentage, and the firm would have to do their best to satisfy that client's sustainability preference. But of course, that, while maybe appealing in the abstract, is not really practical in the market itself. So what I would advise anyone with this question to actually raise it in the ESMA consultation. This is, of course, a consultation process. These guidelines exist to clarify points like this precisely. So if it is a concern of you or your firm, I would certainly raise it. And yeah, I think, you know, I think with that, we're just about at 45 minutes past 3 at Central European time. And so we'll wrap it up. I see there's a few questions we haven't been able to get to, but you know, please reach out to us, you know, bilaterally if you want to follow up. We do our best to respond and have quite a good, I think, response record. So you can, of course, contact me at hugo.gallagher@eurosif.org or federica@federica.casarsa@eurosif.org. So please do reach out. Final thing I'll say before wrapping up is, of course, the next webinar will be on the first Thursday of March. So I believe off the top of my head, that is the 3rd of March. And so we hope to see many of you there when we provide our next set of updates. So with that, you know, thank you very much for joining us this afternoon. And please don't be a stranger if you have any further questions. So many thanks.
Bye, thanks.